Hello, welcome everyone to my very first Tax Talk Tuesday. My name is Riley Holmes III. I am a tax professional. I've been in the tax business since 2006. I've been doing taxes for over 15 years. I'm also a tax virtual instructor. I've been teaching tax law for a long time, over the last 12 years. I'm a certified master virtual instructor, and I'm also with the AFSP program with the IRS. Today I want to talk about Tax Talk Tuesdays. Well, I'll be doing this every Tuesday on Facebook Live and also on Zoom. Also, we'll have a YouTube page, so you can subscribe to my YouTube page. I'll let you know that in the near future. But today we're going to talk about income and how it affects you as a taxpayer. As we know, it is 2024. It is the new tax season. We'll be preparing 2023 tax returns. The IRS has not yet released the e-file date for taxes. However, it will be coming soon. Normally, it's around the 15th or the 20th of the month when the IRS releases the e-file date. But today I wanted to get into your 1040 and income and what that means to you as a taxpayer. We know most people are W-2 employees. They receive a W-2 from their employer. And once they receive that W-2, they file their taxes. So what does that mean? Well, when you receive your W-2, you receive a certain amount of income, and then you have your employer withhold taxes from that income that you receive, whether you get paid weekly or bi-weekly or monthly. And they take out taxes from your checks. And then once you file your tax return, you would include that in your 1040, the withholding, all of your income you receive, and then the 1040, on the 1040, you would put your withholdings, and you would either get a refund or a balance due. And in most cases, people receive refunds based on their tax liability. So when we talk about income and we think about income, we know that, again, the most popular is W-2 income. And when you receive W-2 income, again, as was mentioned, you have withholding that your employer withheld from you. You get your tax liability, and then you receive a refund. Also, too, when it comes to income, you have self-employed individuals. A lot of people who run their own business, whether they run a cleaning company, or you drive Uber, or you do Uber Eats or DoorDash, or you drive Lyft, or you run a landscaping company. Whatever type of business that you run, you have all of your income that you receive, and then you have your deductions, that money that you spent on your business. Once you get that net income, then that determines your tax liability. And that's called a self-employment tax. And what does that include? Well, the self-employment tax includes your Social Security and Medicare tax that will be withheld in your behalf, because you don't have an employer to do that for you, since you are the owner of the business. You are the employer, essentially. You are the employer and the employee, if you will. That self-employment tax covers the Social Security and Medicare tax. Once you have that tax liability, that self-employment tax, you have now your tax liability. And whether or not you sent in quarterly payments, or we like to call them estimated payments, the IRS calls those estimated payments. Most people know it as quarterly payments. Then you'll either get a refund or a balance due based on how much your liability is, in addition to how much you sent to the IRS as a quarterly payment. If you sent no quarterly payments and you have a profit from your business, then obviously you'll have a tax liability. Now, if you're reporting any losses from your business, then therefore there's no liability because you cannot tax negative income. However, the goal, obviously, for a small business owner is to make a profit. And when you do make that profit, you have to pay taxes on that profit. And so we'll get more into that. We'll have a segment about self-employment income and what that means and all the potential deductions that you qualify for, and how to send in if you're just starting a business or you're new to this, or if you've been running a business for years, you may learn some things maybe you didn't know before. And we'll talk about that eventually. Another type of income that we see is tip income. A lot of people receive tips: restaurant employees, hotel employees, airport employees, DoorDash, people who deliver food, they receive tips. And obviously those tips are reportable. You should be reporting those tips, and they are essentially taxable when you do receive tips. And in the event that you do, obviously, those add up throughout the year. And then if you're running a small business, if you're a W-2 employee and you're receiving tips, there is an allocated tip section on the W-2. However, if you're self-employed and you receive tips, then you would obviously file a Schedule C, including that income, which is considered essentially self-employment income, even though it's tipped income, or you can put it, there may be a way you can add it to other income, but again, that's a little tricky there, other income section on the 1040. But nevertheless, we'll talk more about that and how that works with tipped employees. Moving on to interest, you may have received some interest from some banks that you have investments in, or you have a savings account or a money market account, or any type of account that you may have. You may be receiving some interest from those interest-bearing accounts. Well, the IRS rules say if you make anything over $10 of interest, then that is reportable and taxable. So you must report interest on your tax return. Another section on the tax return is dividends. Well, what are qualified dividends? What are ordinary dividends? Well, that's essentially money that you have if you invested in a company or a stock or some investment that you may have. That company, when they make profits, they will send you dividends to the shareholders. And if you're a shareholder, you will receive that dividend, whether it's a qualified dividend that's reportable but not taxable. Ordinary dividends are taxable. A lot of times people may receive dividends, but they may not receive them in their pocket, so to say, or so to speak. However, it is reportable to the IRS that this individual got a dividend. Again, you may not see that in your pocket, to say, per se, from your, whether it's Fidelity or Schwab or whoever you deal with, Fisher Investments. They may just take that money and reinvest it for you. And so that's where the dividends come in at. But again, it's still reportable to the IRS. Next, IRA distributions. A lot of people receive money from a traditional IRA. I like to always say that the TTT method, a traditional, is taxed when you take it out. When you contribute to a traditional IRA, you defer that tax. So you lower you get a deduction on your tax return when you contribute to a traditional IRA. However, when it's time to take that distribution from an IRA, then that is considered taxable income to you when you do receive that. Roth IRAs, on the other hand, those are taxed before you make that contribution. So any distributions from a Roth IRA has already been taxed already. Pensions and annuities. If you are receiving a pension, if you're retired and you're receiving a pension from your employer that you've worked for so many years, then that is essentially taxable as well, because those were tax deferred at the time of your receiving that pension income. So now you've retired. You're now receiving a monthly check from your employer, former employer that you retired from. Those distributions are taxable to you as a taxpayer, unless you have already paid the tax on that. Some pensions, you've already paid the tax on it. You have employee contributions. So now you're receiving distributions that you've already paid taxes on. Well, obviously those are not taxable. But in a lot of cases, in some cases, individuals have not paid taxes on that distribution yet. So therefore, when they do receive it, it is considered taxable income. Social Security, a common misconception about Social Security, that is not taxable. And that is correct, partially. Social Security is not taxable if that's all the income you have. It's only Social Security. However, based on your other income, if you are an individual who receives pension income, or you receive other income from maybe a W-2 source that maybe you have, you've been working while you're retired and you have some W-2 income, based on that income and how much that income is that you've received, whether again from pension or W-2, your Social Security possibly could be taxable up to 85%. Again, based on another income. A lot of people, when they retire, they have investments as well, or they have, again, pensions or accounts that they are receiving required minimum distributions from. Possibly, again, that Social Security may be taxable. Again, it's all on a case-by-case situation when you think about Social Security. Another thing about Social Security, if you do have other income and you are just starting to receive Social Security, what happens in a lot of cases where individuals are just receiving Social Security is that they get a surprise that they owe money that particular year that they started receiving Social Security. Well, why is that the case? Well, now they've added Social Security in addition to their other income that increases their income, possibly a liability. A lot of people do not have withholdings from their Social Security, and so that may possibly be a liability. So when you're receiving that income from Social Security, you may want to check that and possibly get some withholding from your Social Security based on how much you're receiving. Again, it's a case-by-case scenario, and we'll talk more about that in the future. Another thing I want to talk about is capital gain income. You may have some investments from a company that you may have invested in, whether you use E-Trade or Acorn or whatever investment tool that you use to invest, whether you have stocks in Amazon or Apple or Microsoft, whoever you invest in, any pharmaceutical company, whatever company that you invest in, you may receive some capital gains if you sell a stock. Now, if you just sit on your stock, obviously there's no tax liability or no tax implications. However, if you sell your stock, whether you purchased 30 shares or 300 shares, and you sell a portion of those shares or some of those shares, based on how much you sell those, how much you purchase, the purchase price of that stock, in addition to the sales price of that stock, whatever the profit is from that, that is taxable income. Now, the cool thing about capital gains tax, if you do have qualified dividends and capital gains tax, that is a lower rate as opposed to a normal regular tax rate. So that helps as well, your tax return, to get taxed at a lower rate if you do receive any capital gains. Other people have additional income, whether it's from a K-1, maybe you're a partner in a partnership, whether it's an S Corp or a C Corp or an LLC, depending on the type of LLC you're in, you may receive a K-1, which is distribution from your investment portion of the company. For example, if you own a bar, it's 3 owners. You guys split the profit 33.5% per shareholder or partner. You are responsible for that portion of the profits of the company. If the company profited, for example, if the company profits $50,000, 2 shareholders, well then, if you split it 50-50, this person will have a $25,000 K-1. The other partner will have a $25,000 K-1. Obviously, those pass-through entities, which is S Corp, C Corps, and some partnerships, when they pass the money down to the actual partners, then the partners are responsible for the tax liability. Moving on to landlords, if you own a property and you are renting out your property, everything is fully deductible. All the income that you receive, again, this portion is about income. All that income you receive, You can take deductions from that income. We'll talk about deductions next week. But if all the income that you receive from your business as a landlord is taxable, again, we'll get into more of the deduction part at a later time. But a lot of landlords who do receive income, when they take those deductions in addition to depreciation, they now have a smaller profit from their business. Obviously, that profit that they receive is taxable. And most landlords know that. Most business owners know that. That's why they send in quarterly payments, because they know they'll be at a profit, they'll have a gain, there'll be a tax liability. I already know that. I paid the IRS with my quarterly payments, my estimated payment. That's why it's called an estimated payment, because you're projecting how much your profit will be in addition to how much taxes you will owe based on your filing status. And then that will determine how much you need to pay into the IRS. Now, hopefully you overpaid, you have a surplus, you'll get that back in a refund. Or if you underpaid, you may owe a small liability. So in either case, it's all an estimate based on the type of money or profit that you may receive. That's pretty much covers the income section. There's, again, a lot more involved in income. That's just a small, brief overview of income and what you will receive on your W-2 or on your small business return, which is usually filed on the Schedule C, whether you're a sole proprietor or an LLC. Those are the different subjects and topics that cover under the umbrella of income. Again, worldwide income, it's a huge umbrella. There's a lot under that subject. We can talk for hours about that, but the basic points of the few lines in the income section on your 1040 talks about, again, what do we see mostly? W-2 income and self-employment income. So hopefully you learned a little something today about income and what it means and what it means to you as a taxpayer. I do kind of want to talk about filing status a little bit, because that has a lot to do with income, whether you're single, married, head of household. That affects your income, believe it or not, because based on your filing status determines how much you can reduce from your income, which is very important. If you're single, the 2023 rate is $13,650 that you can subtract from your income. So you always need to know that, especially if you are a self-employed individual. You want to know that because you get to subtract that from your income. If you're single, $13,850 is the new standard deduction for 2023. If you are married, filing jointly, $27,700 you get to deduct from your income as a standard deduction. That reduces your income significantly. Head of household, $20,800 you get to subtract from your income. Very nice amount if you are head of household. And you, again, if you're running a business, remember you get to reduce that from your income as well. And then qualifying surviving spouse, if you have a dependent and your spouse has passed away in 2023, the IRS will allow you, again, keyword, if you have a dependent, you can qualify for that surviving spouse status. You get to subtract, again, $27,700 from your income based on that filing status from the IRS. So those are the filing statuses that we have for 2023 that the IRS has for 2023. Again, we'll go over that again. Single, married filing jointly, married filing separately, head of household, and qualifying surviving spouse. Why do we care? Because if you receive a certain amount of income, that amount will subtract from your income. Now, having said that, we're going to talk about this in another segment about standard deduction versus itemized deductions, and also filing requirements. Well, what does that mean? When do I know if I'm required to file, if I need to file? Do I necessarily have to file? It's all income based, and we'll talk about that in another section, the filing requirements and what is the income requirement for me to even actually be required to file a tax return. And if I'm not required to file, should I still file anyway? So that's another important question that we'll cover in another segment of our Tax Talk Tuesdays. So thank you so much for coming. I appreciate you watching this video. Again, I will please subscribe to my YouTube page, Tax Talk. We'll talk more about taxes throughout this tax season in 2024. Thank you for watching. Please come back and see us. Share with a friend. Tell a friend to tell a friend. If you want to learn more about taxes, how it affects you and your family, please, again, subscribe to my page, and we'll talk more. And feel free to shoot me any questions that you may have regarding your tax return. Again, this is that time of the year. For the next 16 weeks, we'll be talking taxes. All right, take care and have a great day.